Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of November 16th, 2025. And in this week's episode, we are going to touch on put selling. And what does put selling have to do with the passage of time and collection of money? Time is money, as so they say, and why not try to translate that into getting paid while you are taking your time collecting and building a base of an underlying that you want to go long on? And that's exactly what we're going to touch on in this episode, and how the traditional buy and hold investors really might want to consider the put selling to enter their positions and why they might want to do that. But before we hop to that, I want to give a shout out to the Discord, a link in the description below. You can click on that, enter our Discord. You can say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Finally, this is available in an audio-only format wherever you get your podcast. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. And in this week's content, I really want to take a step back and try to make a case to somebody that has not traded options, has not really felt that they've had an interest in the options. They are a buy and hold investor. And I want to make a case on why you should consider put selling as a way to augment your buy and hold strategy. And where I'm going with that is, you know that as a buy and holder, what a market order is most likely. Market order is you put your order in, whatever the bid is, whatever the ask is, your order fills whether you're buying or selling at that price. Whatever the market is charging, that's what you just buy instantly. That's a market order. The order goes live and you pay whatever the bid and the ask is going on. You might also be familiar with a limit price. A limit price is where you set a target price and your order will execute once that limit price is hit. So, for example, if you were buying shares of a particular company, you will set the limit price lower than where it is currently trading. And when it reaches that limit price of that lower amount, your order will execute at or below that price. Means at the price you desire or a better price is when your order would execute. If you were selling a limit order, you might do it on as the price rises. So once it hits a limit, then your price unloads and your order executes. And that's all well and good. It's very easy to understand. You pay whatever that price is of your limit order times the number of shares that you're buying. And a market order would be the number of shares you're buying times whatever the current market price is. So why would you want to do anything different? And I want to equate this to something that you might always enjoy of something, but then you add something to it. And I was really trying to think of the best analogy for that for this episode, and I really couldn't think of one that really jumped out at me. But the closest thing I could think of, you might like ice cream, and you might eat a lot of ice cream. You might like different flavors of ice cream. And that's all well and good, and you enjoy it. And then somebody comes along the way and says, you know what, here's your ice cream, but do you want a free little waffle cone to go with your ice cream? Or maybe you want some free sprinkles or something else that is an add-on to that base that you're already accustomed to and already used to. And sometimes you'll try that add-on and realize, wow, that takes the original thing that I like so much and it's added another dimension to it. And that might go really great with certain ice cream flavors, certain things like that. Now, maybe not all of them. Maybe sometimes you're like, you know what? I really like this specialty ice cream flavor and the sprinkles really ruin it for me. And so maybe that add-on is not really there. But if you never try that add-on and you never really know what type of dimension that might add to the thing you're already accustomed to, that's really where you got to go out and try that. And to me, that's really where this strategy of selling a put really can kind of come in. So you think of it like you got a particular underlying, you're going to buy the stock anyway. Now, whether or not you're going to buy it with a limit order, you're going to buy it with a market order, either way, you're intending to purchase that underlying stock price because you think it's going higher. Well, why not go ahead and sell what's known as a put? And that will collect money for you while you wait for that order to be executed. Now, it doesn't carry the same execution guarantee that a limit order or a market order is, but for that patience that you're going to gain from that, for that time that's going to pass, they're going to pay you for that time, and they're going to pay you for that risk that you're willing to take because you know what? You wanted to buy this stock anyway. And so I want to jump into this with a particular underlying, and this really could be any kind of underlying, but back to when I mentioned, some ice cream flavors go well with toppings and some don't. You might look at this particular strategy for whatever underlying you want to buy, and it might not be worth it to you. And what really kind of determines that in my mind, for me, is how volatile the stock price is and how much extra premium is in the option chain. Now, if you're a diehard and you're going to buy it no matter what, then you might be the type of person that always likes sprinkles on their ice cream. But you also might say, you know what, I really just want to hold this and I don't want that overhead of not knowing whether the order will fill or not, because when you sell an option, it's not really guaranteed to execute. So before I hop into the example that I want to talk about, let me just briefly explain what a put actually is. So a put is a contract or a coupon that you will sell to somebody, and that gives that person the right, not the obligation, but the right to go and put shares to you at a particular price. So for this example, we're just going to talk in 100 shares. Every contract always represents 100 shares. So if you want to purchase in denominations that are less than 100 or not divisible by 100, this doesn't work. So you have to be ready for 100 shares. But what you'll do is you'll sell one coupon of a particular underlying, and you'll say, I'm going to sell you this coupon for $400. And whoever buys that coupon will pay you $400, but you will now be obligated to purchase 100 shares of whatever that coupon stands for at whatever price is associated with it. And that's the risk you're taking, is you might have to purchase 100 shares at whatever that strike price is. The benefit of this is, one, you get paid, but you might think, well, I don't know if that's so great. Well, it is, because you get to pick the strike and you get to pick, the expiration of how long that coupon is good for. And so I'm going to jump into this with the first example, and I decided to try to stick with something that's relevant in the news today, and I went with MRVL Technologies. It's a chip company. They've really been kind of moving a lot with AI. They've gone up, they've gone down. The volatility is kind of stoked up. So here is this hypothetical example. And in this hypothetical example, you have to, one, have this prerequisite of you're going to buy these shares anyway. You want to go long MRVL. You might have a particular price in mind that you want to go long from. I don't know, but either way, you will be okay to go long from a certain price. So you got a couple options. Like in my example, right now, MRVL is trading at about $89 a share. So you could go and you could buy it right now at $89 a share. We're talking 100 shares here, so that's going to cost you $8,900. Cool. Then you would own 100 shares, and maybe it's going to go to 90, maybe it's going to go to 95, whatever your price target is on it. Doesn't matter. You're willing to pay that $89 a share for 100 shares right now. Another thing you could do is you could say, you know what, I don't really want to pay $89 a share, but I think it's going to go up, but it's going to pull back a little bit first. So you know what, I'll go ahead and buy it at $85 a share. So you might put a limit order in at $85 a share. Now, I'm not talking about a limit order here because this is a sell order with a strike price. But before I get to that, let's just hypothetically say a limit order. So you put this limit order in, you say, hey, if I get down to $85 a share, go ahead and execute, buy me 100 shares. If it gets down to $85, you will pay $8,500 for those shares. You've got your shares, you're happy, and you're going long. Now, what happens while you wait for that share price to hit $85? Nothing. You just wait. You don't collect any money. You don't lose any money. You don't gain any money. You just sit there and you watch the stock price maybe go up to 95 and you're sad because you said, oh, geez, I could have bought it at 89. Or maybe you see it dip down to $85.01 and your order doesn't execute because you haven't hit that $85. Either way, nothing's happening unless that drops below $85. Your order's not going to see any action. So this is where selling the put comes in. And so we could take an $85 strike price and say, you know what, I'm really comfortable purchasing this at $85. So I am going to go ahead and sell a coupon to somebody out there that says, I will give you the right to give me or put to me 100 shares of this underlying, and I'll pay you at $85 a share, no matter what price that goes down to. And that coupon is going to cost a certain dollar amount. And I'll show you this in the option chain, but right now, that particular strike for about a month out is selling for $6. So that means there's a $6 premium for every share, 100 shares. So that coupon would cost somebody $600 to buy. So if you're selling it, you get that $600. If the stock stays above $85, you keep your $600 and you don't get any shares. Same outcome as that limit order we talked about. Now, let's say the stock drops down to $80. In the case that it drops down to $80, you still keep that $600. And if it is below that $80 or $85 at the time of expiration, and this is where it's not like a limit order, so it's not immediate execution, but if it is at expiration, you have to pay $85 for those 100 shares each. So you pay $8,500, but you get to keep $600. So you really bought the shares for $7,900 because that's how much it actually cost you. Now, what if you had the limit order out there and the price dropped to $85? As soon as it went 1 penny below, that order would fill. You would spend about $85 a share on that. And what if it continued to go down to $80? You would have bought it at $85 and it would now be trading at $80 and you would have been out $8,500. You see where I'm going with that? So where I'm going with that is you have basically kind of gained $600 no matter what happens, as long as you're at that point where buying that underlying at $85 was okay for you. Now let's stick with MRVL and let's go over to the option chain. So the option chain is basically the price book for these coupons that you can sell for a particular strike price. And what you'll see when you look at an option chain is various expiration dates. So think of this. This is when that coupon expires. The number inside the parentheses here is what is the days to expiration. So these are, this first ones are 37 days out. 44 days out, you can get them up as close as this week of expiration, and different expirations. And then when you say, you know what, I want to try to go about a month out, that's this December 19th expiration. The number over here on the right is the volatility. So the higher the number, the higher the premium. But let's just go ahead and look at the 19th of December. Now, what you have here is basically all of these different strike prices. On one side, you have the price of the call options. We're going to ignore that because we're talking about puts. And on the other side, you have the price of the put options. In the middle here, you have the strike price at which the coupon is good at, or the execution price. So, for example, the one that we were talking about is $85. If you were going to sell the $85 put, you're going to look at the mid price here between $5.75 and $6.20, which is going to be about $6. So if you were to sell this 85 put, you would collect about $600. Now, here's where you could maybe not be that comfortable and say, you know what, I don't want to buy it at $85. I want to buy it at $80. You could step down and you could sell this put at the $80 strike, because maybe that's where you want your limit order. Maybe that's where you're more comfortable buying MRVL at. And that you're going to split the difference there, and you're probably going to sell that for about $400. So the difference here is you're basically stepping down a whole $5, but you're still collecting $4 per contract, or $400. Now, you could get really bullish and say, you know what, I really think MRVL is going to go up, but I don't know how far it's going to go up. But, I want to go ahead and sell something that's above the strike price. And, you could sell, I'll buy it at $95. And if you want to go sell it at $95, yes, that's above the current strike. So you would be in the money right away. But again, these orders don't typically execute because the person that's buying it is maintaining the right, but not the obligation to turn it in. So they could turn it in at any moment. However, they are more likely going to hold it as a hedge. And if you were to sell this 95 strike, you could see you're going to be collecting about $11.50 $1,150 to purchase at 95. Now, let's say you did that and this stock price shot up to $100. Well, your order probably wouldn't get assigned because you're going to be out of the money at that point. But that $1,100 that you collected would be 100% yours, and you put it in your pocket. And that's really what I'm talking about, where if you have the time and the patience to basically, maybe you get assigned, maybe you don't, they're going to pay you to sell that coupon and wait. And then as soon as December 19th comes around, if the stock price is above your strike, it's done. It's worthless. It's gone. And you can sell another one. If it's under your strike price, then you will be assigned at that strike price. So if we sell this 85 and on December 19th, it closes at $84.99, then you will purchase 100 shares at 85, but you keep that 600 that you sold. And the parts that make up this premium that you collect are primarily two major factors. The first one is the volatility number. So in this case, that December 19th is about an 80% volatility. And so the combination is that volatility number combined with how many days out. To illustrate this, let's go ahead and go out to a number that's much lower. Let's say the 18th of September in 2026. That number is only 57%, but that's 300 days away. So let's look at this same option chain and go down to that same $80 or $85 strike. And look here. That strike will now, if you go sell that, now it's almost a year out, but you will be able to collect probably $1,500 for selling that strike. And that's a really long dated option. I don't typically sell that long, but you see where I'm going with this. Where I'm going with this is when you find an underlying that you are willing to purchase at a particular price, go look and see what the option chain looks at. Consider selling a put at that strike instead of putting a limit order at that strike, and just see how that sits with you when you put it out there. Because you have to remember that in this situation, in the prerequisites, as I said, is you're already interested in buying MRVL. You're already okay to buy it at $85 a share. So if you're already ready to make that move, you're already ready to execute that, what's the harm in selling the option? And I would say that their harm is largely, but not that big, because if it goes above and it never hits your limit price, in the case of your limit order, you never get filled, but you never make any money and you never lose any money. If the price goes below your strike with a limit order, your order would execute at the limit price. So you would spend $85 a share. And if it went below $85 a share, you would be technically unrealized profit or loss of how far ever low it goes below that $85. That's in the case of the buying straight shares with a limit order at 85. Now, the flip side is let's go ahead and put a sell a put option out there at that same 85 strike. So at the time of expiration, if you're above that $85, guess what? Yeah, keep the $600. You didn't fill because you didn't hit your limit price or the option wasn't exercised, but you had $600 in your pocket. You didn't lose any money and you made $600. Now, let's say that the stock price goes down and it's below $85 at the time of expiration. Well, you will have been assigned at expiration for $85, so you have to pay $8,500 for the shares, but you also have $600 in your pocket. So you have effectively still paid $600, paid $8,500, but you still have $600 in your pocket. And if the stock price was down at $81, you actually don't have an unrealized loss because you have that $600 to offset that negative $400 that you took down. So you're actually plus $200. So you might think that's a win-win. And that's the way I really look at it, is it kind of is a win-win, but I would tell you the risk or the loss that you might have is you might not get assigned. And if you really, really, really want the shares, This is not a guaranteed execution. This is not a guaranteed way to fill. And for me, that's okay because I'm not in a hurry. I'm ready to take my time. And if you're willing to take your time and maybe miss getting a sign because it stayed out of the money, then you just repeat the cycle as soon as the option expires worthless and you sell something else at another expiration date, maybe the same strike, maybe a different strike because maybe it's been going up. You get to craft that. So I just want to pull up the chart real quick here. This is the chart of MRVL, and what I want to show you is maybe you happen to be a price action guy, and you're kind of looking at the price action of MRVL, and this is the daily candles. You had a big drop here, but then we've kind of been gaining and kind of making a little bit higher highs, higher lows, and we're kind of stair-stepping it up. So this, maybe you take this chart and you read it as, hey, we're going to continue to keep going up there. And maybe on that read, this is how you decided to go long. So whatever your screening mechanism really is to get to this point, it doesn't really matter. What I think really matters is, are you willing to go out and sell an option in a different way? Are you willing to try sprinkles on your ice cream to see how it fits you? Because it doesn't really matter if you're a chart person, if you're looking at just fundamentals, whatever it is, you find the option of the underlying that you want to go long on, check the option chain, and just see what it looks like to sell a put on that, which is effectively the same thing as going long the shares. Now, it's not guaranteed execution, but as long as you're okay with that, you're going to be able to collect money as you wait. And that brings us to the end of this week's content. It's a really quick episode this week. I wanted to try to keep it pretty simple because I'm really targeting here, if you're the type of person that's going to buy a stock anyway, and you already have a preconceived price in which you want to purchase it at, I highly encourage you to go to your broker, go to the option chain and sell a put. You really don't need any sort of extra permissions in most brokers if you already have the cash to execute the order. That's what's known as a cash secured put, where basically your broker will sequester that full cost of what it's going to take to exercise the option if you have the lowest level of option authority, which most brokers will give you just out of the box by having it. If you want to trade on margin or things like that, then you might not, you have to have the cash to cover the order. If you have a more advanced account and you're higher level cleared for options, you can do options on margin. But for the audience that I'm talking about, for the cases that I'm talking about, you already should have the money in your brokerage account to buy the shares. You have to already be thinking about it. And all I'm asking you to do is go into that option chain, go to the strike that you want to buy it at, and sell a put at that strike. Target 30 days out, target 45 days out. Don't do it like a year from now. Just do it something about a month and a half out. See what happens. Because what you're doing there is you're getting your ice cream and you're putting some sprinkles on it, and see how that hits you. See how you like the flavor. Maybe you don't. That's great. Now you know. But maybe you'll taste it and say, wow, why have I been missing this? I want to put sprinkles on all my ice cream. And that's where you can kind of go to this extra dimension and really enhance the experience and enhance the profitability. And what I would say is getting paid to wait. So if you're a buy and hold person, you're probably already not in a hurry. And if you're already not in a hurry, then what's the harm in selling a couple of these coupons to collect money that may or may not execute? Because if they execute, you're already going to do that anyway. And if it doesn't execute, well, you get to keep the money and you just do it again, or you wait a little bit longer. And so I think if you're in that boat, try it out. You never know how it's going to hit you, and it might add a total new dimension to your trading game. So go out there, look for some sprinkles to put on the ice cream that you're already going to buy. Good luck, have fun, and remember, think outside the block.